Friday, September 7th, the first Friday in each month, has the largest, most important reports on the economy come in all just in the first few days. But before that, the anxiety level out there about American politics is pretty high for a lot of people, and other people are embattled on the other side. So be careful. But the financial market reaction to Woodward's book and to the New York Times op-ed, zero. Woodward is a great reporter, and he reported, but the reporting is for the most part just ruffles and flourishes around the edges. It isn't new. The New York Times op-ed is also not new. I mean, anyone who didn't suspect that there are people in and near the White House actively trying to manage its operations, in some cases against the will of the president. I mean, a lot of that goes on in any administration. And the New York Times op-ed piece was an act of psychological warfare designed to discombobulate the president. And it has succeeded beyond the inventor's wildest imaginations. But all large organizations have rebellions. Being president is tough. Most people never get to meet a big corporate CEO or spend much time near them while they're in action. And so most of us have a view of these large organization leaders that's, out of TV dramas. That's not who they really are. Most of the time their lives are unbelievably boring and exhausting. But the rule book for how to behave when you are attacked in the form of either Woodward or the New York Times op-ed is to appear on CNBC, smile and laugh, point to the size of the organization. Any number of people are likely to be unhappy at any given moment, but we have work to do, and we're going to get on with it, and not overreact to it. Well, even that hasn't had an impact on markets. It's fascinating to watch markets trade as the news scrolls across the bottom of the screen, and it just doesn't matter. This tariff business may matter if we drop something on China next week, but the important stuff is the economic data. And the economic data is clear. Today we got job data for the month of August, and the job data is just the same as it's been. There was a little uptick in wages, but the rest of the job information about things like unemployment and percent of the population at work, all of that stuff was right on basic trend. But interest rates went up. Why did they go up? I think everyone should get used to the idea that mortgage rates in particular, are going to oscillate. They're going to wobble just based on the flow of data that appears. If we get a strong piece like today, up we go. If we get a weak piece, we'll go down a little bit. But we've been in the same basic place ever since February, and we're going to go out of it one day, and it'll be a surprise that day. But the big thing ahead, the most important thing, is the Fed is about 3 hikes away, 3/4 point increases away from a pause. That pause may last a month, and it may last a couple of years. Nobody knows. Sometime this winter, the Fed is going to have to begin to discuss, do we stop our hikes altogether? Do we pause and continue upward, or do we just continue upward? Depending on how we think the economy can tolerate growth, especially job growth, that's way above trend. And they're going to have to do it in public. It's a bad idea for the Fed to surprise financial markets. And the Fed knows that. In the old days, the Fed thought that it should surprise markets, but not now. Sometime this winter, maybe sooner, the Fed's going to have to begin to discuss actually trying to slow the economy down. In the last 3 years, the Fed has had the great luxury of saying, we're just normalizing. We're not really doing anything, we're just rearranging the furniture. And sometime this winter it's going to be for real. And as new data appears between now and then, that'll be markets trying to figure out what the Fed is going to do then. On that note, have a great weekend.